Welcome back, everyone. NatWest Q3 earnings are out, and on the surface, it's a blockbuster. Higher income, stronger capital, record returns. But investors know better numbers only tell half the story. So today, we're peeling back the layers to find out whether NatWest's rally is built on real strength or temporary tailwinds. Let's dive in.
Okay, so when you first look at these numbers, they are, well, pretty startling. Attributable profit for Q3 really jumped.
It did hit $1,598 million.
Which is, well, what, nearly a 30% increase over the previous quarter?
Exactly, 29.3% up on Q2. And total income, if you exclude the notable items, that was strong too, $4,166 million.
Yeah, about 3.9% quarter on quarter. I mean, these figures make it look like everything's going incredibly well.
It's definitely a huge quarter on paper. But, the real question isn't just the profit number itself, it's how they made it. How efficiently.
Right, and that's where the return on tangible equity, the ROTE, comes into play.
Precisely. That's the key metric investors look at, to see how well the bank's using its capital. And NatWest's ROTE hit, an almost eye-watering 22.3% in Q3. Wow. That's a big leap from Q2, wasn't it? Like 4.6 percentage points higher.
It is. That suggests, world-class efficiency on the surface.
Okay, that ROTE figure gets thrown around a lot, but I seem to remember there's a catch, a sort of asterisk next to that number.
Absolutely. There is,
Okay.
and it's a really important one. While the underlying performance was definitely strong, you need to know that more than 2 percentage points of that really impressive 22.3% ROTE came from one-off items.
Okay. So the repeatable structural gain is still good, just maybe not quite as dramatic as the headlines suggest?
Exactly. Still strong, but slightly inflated by those one-offs.
So if part of that efficiency boost was temporary, where did the rest of the genuine strength come from? I'm guessing margins and costs?
Yeah, it was almost all driven by interest rates, specifically what they're paying or not paying on deposits. Their net interest margin, NI, that's the spread between lending and borrowing costs.
Right.
That expanded by a solid 9 basis points, up to 2.37%.
And how did that break down?
Well, if you unpack those 9 points, 4 of them came directly from deposit margin expansion. So paying less on deposits, lending margins only added about 1 basis point.
Interesting. So the immediate profit jump is really a direct result of higher rates keeping those funding costs down for now.
That's a huge part of it, yeah. The current rate cycle is definitely helping.
Okay, so the deposit story is key for profit. But what about efficiency? Did they manage to keep costs under control?
They did extremely well, actually. You combine that margin expansion with what the CEO calls tight cost control, and their cost-to-income ratio dropped quite significantly.
How much did it drop?
Went from 49.1% in Q2 down to 45.8%. That's a really substantial improvement in just one quarter. Shows they're spending less to make more. That part looks genuinely structural.
Okay, let's shift gears a bit. Away from the income statement, look at the balance sheet. Capital strength. We always hear about the CET1 ratio.
Yeah.
Why is that number actually important for listeners?
It's super important. CET1, that's Common Equity Tier 1. It's basically the bank's main safety cushion, the highest quality capital they have to soak up any unexpected losses.
So higher is better, means they're safer.
Exactly. Higher means more resilience and, crucially, more capacity to give money back to shareholders through dividends or buybacks. And NatWest's ratio is sitting pretty high at 14.2%.
Which is up from Q2 as well.
Yeah, 60 basis points higher than Q2. That's a comfortable position.
So that 14.2% looks robust. What does that ability to generate capital actually mean in practice?
I mean, they have options, lots of options. Just in Q3, they generated an incredible 101 basis points of capital before paying out anything like dividends.
Wow, 101 points in one quarter.
Yeah. Think of it like this, that internal growth builds up their capacity really quickly. It means they can potentially do more share buybacks or bigger dividends than some of their peers. It's a really key signal for shareholder returns.
Right. Got it. So strong capital cushion, and it looks like they're putting it to work growing the loan book. Customer loans are up, 4.4% since the end of last year?
That's right. And net loans were up 1.2% just in the quarter. That's about 4.4 billion pounds. So, yeah, clear lending momentum there.
Okay, but here's where it gets interesting, isn't it? You mentioned the income story was driven by deposits.
Exactly. And this is kind of the central tension in these results. The funding side. While overall customer deposits look okay year to date, up slightly, if you filter out some central items and just look at core customer activity, deposits actually decreased slightly in Q3 by about 1.1 billion.
Hold on. So they're growing loans pretty fast, adding 4.4 billion pound, but core customer deposits are shrinking a little. Isn't that a bit of a warning sign?
That is precisely the potential early warning sign. It suggests NatWest might have to start relying more on more expensive funding sources like the wholesale markets.
Or maybe dip into that nice capital buffer they've built.
Or potentially, slow down the loan growth eventually. It shows the fight for customer deposits is definitely getting tougher. Those easy margin gains from low deposit costs might not last forever.
Okay, that makes sense. Let's dig into the different parts of the bank then. See where the success and maybe those pressures are showing up. Starting with retail banking.
Okay.
Looked like a powerhouse this quarter.
Retail had an exceptional quarter, pulled in $850 million operating profit.
And a huge return on equity rate, 26.4%.
Massive ROE.
Hmm.
And their income rose 4.3%. Retail is actually a perfect example of that mix we talked about, temporary boosts and real structural gains.
How so?
Well, they clearly benefited from the temporary tailwind of deposit margins widening because of interest rates. But they also got a structural boost from having the full quarter's impact of the balances they bought from Sainsbury's Bank.
Ah, right, that acquisition.
Yeah, that brought in real assets, boosted their mortgage book by £1.7 billion. So retail's kind of firing on both cylinders, benefiting from the rate environment and executing on strategy.
Okay. What about the business side? Commercial and institutional, C&I. They also seem pretty strong, 19.7% ROE, income over £2.2 billion.
C&I also delivered solid strategic growth. Their lending was up £2.5 billion.
Where did that come from, mainly?
Mostly from areas like funds lending, lending to large corporates, and also commercial real estate. And what's quite impressive is they managed this even while absorbing £500 million in repayments from those old UK government COVID scheme loans.
So they're replacing that runoff with new targeted lending.
Exactly. And they're also highlighting their strategic focus, lending $7.4 billion to UK infrastructure and housing associations. That looks like smart, profitable management of that segment.
Okay, now let's circle back to that deposit pressure. Did we see confirmation of that trend in the private banking and wealth management arm, PB and WM?
We did, yeah. It really underlines the broader point. PB&WM profit was decent, $108 million, a solid 23.4% ROE. And their assets under management AUMA, the wealth side, grew really strongly.
How much?
Up 8.1% to $56 billion. Mostly market moves and new client money coming in. That's great for fee income, but
Here it comes.
their actual deposits in that division went down by $1.7 billion.
And why was that?
Management was pretty clear. It was seasonal tax payments, but also clients actively moving cash out of low-interest bank accounts and into those higher-yielding investment products, the AUMAs.
So customers are getting smarter with their cash, looking for better returns.
Precisely. And the bank sees those deposits walking out the door, even if they stay within the wider wealth management offering. It confirms that mix shift away from cheap deposit funding.
This really puts the focus on the CEO, Paul Thwaite, and his strategy. He talked about strong performance, lending growth. But how are they actually planning to deal with these longer-term challenges, like efficiency and keeping deposits?
Yeah, the main strategy seems to be simplification and going digital. Thwaite keeps saying they want to become a much simpler bank through tight cost control.
Is that just talk, or is it actually happening?
No, it seems real. It led to a measurable 5% improvement in their cost-to-income ratio for the year so far. So they are lowering the basic cost of running the bank.
Okay. And how does that simplification show up in the more technical side of things, like balance sheet management? You mentioned risk-weighted asset actions earlier.
Right. This is where their capital management looks pretty slick. They delivered £2.2 billion in RWA, risk-weighted asset management actions.
Remind us what that means again, RWA.
It's basically the value of the bank's assets, but adjusted for how risky they are. By managing this better, maybe selling off assets that don't make good returns, or just getting better at modeling risk, they free up that CET1 capital cushion we talked about.
Ah, I see. So that $2.2 billion action creates more room for them.
Exactly. It creates immediate capacity for more profitable growth, or, importantly, for shareholder returns like buybacks. You combine that with lower operating expenses, they cut about 100 staff jobs in Q3, and it shows real operational grip.
Okay, impressive on the efficiency front. But before we get carried away, we have to talk about risk. Credit risk. The economy isn't exactly booming. What are the loan loss provisions telling us?
Well, the immediate Q3 picture was actually pretty good, near term. The net impairment charge, the money set aside for potential bad loans, fell to 15 basis points. That's $153 million, down from 19 basis points in Q2.
So credit quality held up well in the quarter itself.
It seems so, yes.
Yeah.
Didn't deteriorate rapidly in Q3.
I sense another but coming. if you look at the year so far?
Yeah, if you zoom out, the picture is definitely more, let's say, cautious. Overall impairment losses for the first 9 months are up massively compared to last year,
How much?
up 82.6%. They've set aside $535 million so far this year, compared to just $293 million in the same period in 2024.
Wow, that's a huge jump year on year. What does that signal?
It signals that even though Q3 was stable, the bank is still bracing itself. They're still provisioning heavily for ongoing economic stress and uncertainty. They're definitely not saying the coast is clear on the economy.
How do they account for risks that haven't actually happened yet, but might?
They use these things called post-model adjustments, or PMAs. You can think of them as extra buffers, so specific rainy day funds set aside based on management judgment, not just the standard models.
And what are they buffering against specifically?
They've got an $86 million PMA, specifically for retail banking risks, things like the cost of living crisis, hitting mortgage affordability, and then a bigger one, $139 million, for the commercial side, covering worries about inflation, supply chains, and maybe liquidity issues in some older loan portfolios.
So management is clearly keeping a close eye on those potential economic bumps in the road.
Absolutely. They seem very aware of the lingering risks out there.
Okay, this brings up interest rates again. We established higher rates were helping margins now. But what happens if or when rates start to fall?
Yeah, they've modeled that out. They calculate that a hypothetical quarter point, 25 basis points, drop in rates across the board could knock about $176 million off their total income in the first year.
Okay, so there's a direct, measurable hit if rates fall.
There is. But their main defense against that, longer term, is something called the structural hedge. They actually expect the income from that hedge to be over $1 billion higher in 2026 compared to 2025.
So that's designed to offset the impact of falling rates over time.
Exactly. It's a way to smooth out the volatility and shows they are planning for that shift in the rate cycle. It's about long-term balance sheet management.
Right. So despite the risks and the rate sensitivity, all this strong performance and efficiency led NatWest to actually raise their guidance for the full year 2025. What did the CEO put that confidence down to?
He basically said it was due to consistent delivery and strong capital generation. They've upped their ROTE target for 2025 now to greater than 18.0%.
Still aiming for over 15% in 2027, though.
Yes, the longer-term target remains 15%. They also increased their income expectation for 2025 to around $16.3 billion. And they're keeping a tight lid on costs, forecasting to around $8.1 billion, which includes some integration costs.
That's management signaling real confidence, isn't it?
Absolutely. They clearly feel they have momentum and can deliver on these higher targets.
And what does all that mean for shareholders, for returns?
Well, it strongly suggests higher returns are coming. They expect loan losses, the impairment rate, to stay low, below 20 basis points for 2025. And critically, they're targeting that CET1 ratio we talked about, aiming for 13% to 14%.
And they're currently above that at 14.2%.
Exactly, which means they have excess capital to distribute. Yeah. So the plan is ordinary dividends around 50% of profit starting in 2025, and they specifically mentioned they'll keep considering share buybacks too. That strong capital base is directly enabling this more aggressive shareholder return policy.
So as NatWest closes Q3 with near-record returns and a stronger capital base, the message is clear. Management has execution momentum.
Definitely. But with those deposit pressures clearly rising and the big boost from interest rates probably nearing its peak, the real test is going to be sustaining this kind of growth into 2026.
The numbers look strong now, but it's the strategy that will decide if NatWest can turn resilience into long-term leadership. What's your take? Drop your thoughts in the comments. Is NatWest a buy at these levels or price for perfection? We are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.